Hi everyone, Emily from Finance Made Easy here. Today I'm going to be talking to you about the gross profit margin, what gross profit is, what it means and how it's calculated. So firstly, gross profit. What is it? Well, essentially gross profit is revenue less your core costs, your costs of sales. So this would be purchases, direct wages, any costs which are directly associated with selling that product. So if you have revenue minus cost of sales, you're then left with your gross profit. Gross profit is a really good way of assessing the financial health of the business. If you're not making any profit at this stage, it's likely that your pricing model's wrong, or your costs are too high, and maybe the business isn't even viable. Because obviously once you've got cost of sales, on top of that, you've then got other costs, haven't you? You've got, your rent, your director's wages, insurance, you name it. So if you're not making any profit at the gross margin stage, then your business is in a bit of trouble. So we're going to look at the gross margin and how it's calculated in the next few examples. Right, so let's have a quick recap over gross profit. So, gross profit equals revenue minus cost of sales. Cost of sales include direct wages, raw materials, direct input costs, direct purchases, any costs associated with the actual core product or the core item you're selling. So if we look at gross profit margin is calculated as the gross profit figure divided by revenue times 100. This will then give you a percentage. The percentage from year to year shouldn't really fluctuate too much. If it does, it suggests that your pricing strategy might be wrong, or it might suggest the company is an unstable market where purchases fluctuate a lot. Take for example oil. The price of oil was always going up and down. This means that your purchase costs would fluctuate a lot, and that would affect your gross profit margin, unless you chose to pass on that cost to the customer, which would mean that purchases were higher but sales were also higher, giving you the same margin. It's possible to work out a company's pricing strategy from looking at their margins. So if it's year on year is 50% gross profit margin, that means obviously they mark up their products by 50%. Most businesses have to have their business results online, so it is possible to figure this out. This is a core ratio for understanding the profitability of a company. It's one of the most important ones. If the gross profit margin is too low at this stage, it really does suggest that the business might be struggling to make any profit at all.